Welcome everybody. My name is Lawrence Gosling. I'm the editor of What Investment magazine. Now, one of the really interesting things for investors over the last couple of years really has been how unloved UK equities are. There's been lots of reasons, whether it's the lack of a Brexit agreement, obviously the pandemic in the last sort of 12 months. But to discuss some of these issues, I'm very pleased to be joined by a very experienced UK equity manager, Ken Wotton, who runs 3 portfolios, 2 open-ended and 1 closed-ended, at the specialist asset manager Gresham House. Ken, good to see you again.
Hi, thanks, Lawrence. Good to be here.
Now, as I said, there sort of seems to be sort of many reasons why sort of UK equities are kind of been unloved largely by investors. So we're sort of pretty much the anniversary of 12 months of the UK's first full kind of lockdown. Why do you think even now it's still unloved?
Well, I think this is still a hangover from the Brexit referendum in 2016, and you've seen UK equities out of favour and trading at a discount to other developed markets really ever since that point. And whilst we did have the Brexit trade deals signed in December, really there's still a reasonable amount of uncertainty about how that will play out in practice, and there's concerns about log jams at ports, etc. And also the kind of important element that services are not included, and therefore it's effectively been a hard Brexit for services. So I think that uncertainty, combined with very sort of severe economic damage in the UK from COVID during 2020, more so than in some other sort of equivalent countries, I think all of that has it has prevented the recovery we might have expected this year. I think there are reasons to be optimistic. I think we've got, it may be a light deal, but we do have a deal, so there is one sort of less piece of uncertainty there now. The fact that the UK was so severely impacted by COVID last year gives it more scope to bounce back sort of more rapidly this year. And I think the vaccine penetration, the one thing that the UK seems to have got right, that really does give us some cause for optimism about lockdowns being sort of relaxed as we go through this year, and therefore economic recovery starting to rebound quite strongly. So I do think there's cause for optimism as we go through 2021.
Now, there seems to be a kind of general agreement. There's a kind of large weight of money on the sideline waiting for it to be kind of reallocated to kind of equity markets. In particularly the kind of UK. Do you see that as being the potential catalyst for the re-rating of kind of small and micro cap stocks?
Yeah, I do. I think you've got a large number of investors who are underweight the UK and sort of at sort of multi-year or possibly multi-decade sort of levels of being underweight that market. I think I've seen some analysis actually that shows that even if you adjust for the different sector weightings between the UK and the US, that the UK is trading at a 30-year low point versus the US equity market. So at some point that valuation discount, that has to start attracting money flows back into the UK. And I think that if that does happen, that UK smaller companies have got a lot to benefit from that, because not only does the UK trade at a discount, but UK smaller companies trading at multi-year discounts to larger companies, and it's the smaller companies that actually have a greater exposure to the UK domestic economy. And if you do believe that the economy picks up strongly this year, then it's UK smaller companies that have the most to benefit from that. So I'm optimistic that you could see quite a decent re-rating of UK small caps over the course of this year.
Now, one of the things that perhaps surprised people during 2020, and it seems to have carried on into 2021, is the kind of the amount of M&A and also activity by private equity groups in and around the kind of UK equity market, particularly kind of mid cap and down. Do you see that as a trend, a phenomena that will probably continue through 21 and potentially into 22?
Well, I think M&A had started to really kind of ramp up in 2019, and so until COVID hit, it was certainly in the UK smaller company space, it was at elevated levels versus what I've experienced in my career. And I think that's really down to that discounted valuation. I think Brexit created an opportunity for smart money, whether that's private equity or trade bias who can take a long-term view, can spot a quality business and look through the short-term noise and see a really attractive valuation opportunity. COVID put a temporary halt to that, but I think as businesses have become sort of confident again in their own outlook and their balance sheets, and private equity is still awash with cash, I think the confidence is building, and that has resulted in a tick up again in M&A towards the back end of last year and into this year. And unless that valuation discount starts to recede materially, I think that there's going to remain a feature of the market for quite some time. That's good and bad for small cap investors. On the positive side, it does give you an opportunity for re-rating driven by takeovers, and it gives shines a light on the sort of valuation opportunity. On the downside, it does mean that some good quality long-term businesses get taken out, and we don't get to take sort of the advantage of the full benefit of that opportunity over the next few years.
Now, I was going to ask you about that because obviously there was a couple of holdings that you had in your sort of three portfolios that were sort of taken over, during the sort of period we're talking about. I mean, did you get a good price? I guess is the easiest way of asking the question.
So, I mean, two I particularly pull out. There was a takeover towards the end of last year, a business called Codemasters. It was a stock we held in our UK microcap fund, the video games developer, which is obviously a sector that's very much in vogue at the moment. And Codemasters were kind of the preeminent player in motor games. So they had the franchise for the F1, for example, and we did get a good price for that because that business, there was a takeover approach from a big US games developer company called Take-Two Interactive, but then there was a bidding war, and eventually it got taken out by EA instead. So we got a pretty decent price because there were two interested parties and they were competing to take out that business. It was a rumoured takeover offer rather than an official one, that we saw again at the end of last year, which is Equinity, which the shareholder services business focused on big blue chip companies, and that there was a pretty credible rumour in the press that there was a US private equity firm that was interested in making an offer for the company, and the shares reacted positively on the back of that news, but actually nothing has subsequently come out officially, and we suspect that's because the price that was being mooted in the press, whilst above the share price of the company at the time, actually doesn't really represent that attractive a takeout offer relative to other transactions that have been happening in the private market. And also one of their main competitors, Link, which is listed in Australia, which is also in a takeover situation at much higher multiples. So we think the board probably rebuffed the offer, and we will see whether or not that comes back. But it's a business which has a very strategic market position. Its earnings have been depressed because of issues over the course of last year, but we do think there's an opportunity that the business should recover. And if you were going to sell the company, you would prefer to do that when the business is on the up again, rather than after a sort of fairly torrid year in terms of performance. So we're optimistic that if that does come back, it will come back at higher prices.
Interesting. Now, I think one of the things that sort of happened during the course of 2020 is that you took over the mandate, became lead manager of the Strategic Equity Capital Investment Trust. I think I'm right in saying it's sort of May that you took on that investment trust. How's it been going so far? In 9 months in.
Yeah, so Gresham House won the mandate for the Strategic Equity Capital Trust in May last year. We went through initially a period of review, so a detailed look at the holdings, a detailed look at the investment strategy and how it's being applied. And we did that through our investment committee, which I'm a member of. And through the course of that review, we concluded that the strategy was effective, and there was no reason to change that. And the majority of the portfolio companies were also sort of good quality and had good long-term value opportunities. But we did feel that by putting additional experience and resource behind the trust, we could enhance the application of the strategy and over time improve the performance. It's a long-term vehicle, typically holding companies for 3 to 5 years, so it is a sort of gradual process. So in September last year, I was appointed as the lead manager of the trust alongside Adam Kalmby, who's one of the existing managers. And really we've sort of started a process of gradually evolving the portfolio of the trust to really focus more on taking larger equity stakes in the strategic holdings that we have. It's a high conviction fund. It's relatively concentrated, and we think there's great opportunities around at the moment. So we think that by doing that, by getting me involved, and also by really putting the resource that we have within the strategic equity division of Gresham House, which don't forget has a well-developed public equity team, but also a private equity team sitting in the business, and that private equity network that sits behind our team and really underpins our research process and the way that we go about sort of not only evaluating but engaging with companies. So all of that resource, that experience, we think we can bring to bear on SEC and to really improve the long-term performance. But like I said, I've been involved since September, so it's fairly early days, and we would expect this to be a gradual process.
As you say, early days on running a closed-ended fund. What are the differences, would you say, between running a closed-ended fund compared to the sort of 2 open-ended funds that you've been managing? That obviously you've got a longer track record leading.
I think the funds are playing in the same pond, if that makes sense. So they are fishing in the same pond, I should say. The area of small cap is where we think there's the best opportunity. I think the main difference between the closed-ended fund and the open-ended funds is just around the ability to use the closed-ended structure and the liquidity benefits that gives you to take bigger stakes, have a more concentrated portfolio, and so really sort of put money into those ideas where we have the highest conviction, and then take equity stakes, which allows us to have a platform for some influence with the companies and to really sort of operate our constructive but active engagement strategy with those companies. So we believe that there are opportunities across a number of different areas where we can engage with the companies to help them to the benefit of all shareholders, and where we can leverage our network and introduce experts who can sort of be beneficial to that company, whether that be sort of potential non-exec board members who have specific skill sets which are going to be beneficial to the company and their strategy, or specialist consultants or M&A advisors, or people who we know who can genuinely help to add value to those companies and ultimately improve our returns. So that's the real benefit of the closed-ended structure versus the open-ended structure. And whilst the investment philosophy is very similar and the types of companies that we invest in are similar, it's really about that concentration and conviction that sort of sets the two things apart.
And just finally, I know this is a sort of an unusual economic cycle from ones that perhaps you've experienced and most people have, but we're at that kind of point. I guess, why would you say at this point in the cycle it's kind of worth investors really seriously looking at sort of small and micro cap UK equity stocks?
Well, I think the cycle is notoriously difficult to call, and we don't really. I mean, I certainly don't try to do that. I think I've always tried to invest in companies that have some kind of structural growth driver behind them in their niche market, or some competitive advantage that I believe is going to be sustainable for the long term. And then we try to buy into those companies clearly at attractive valuation. So whilst we don't completely avoid cyclicality, we are trying to mitigate the cyclical elements of an investment case in order to focus on businesses where they can grow and they can drive value regardless of the economic cycle and market cycle. So at the moment, I think it's a fantastic time to be investing in UK smaller companies, and that's partly what we've already talked about the discount of this part of the market and the discount of the UK sort of as a hangover from Brexit. But also what's happened with COVID has meant there's been a huge discontinuity in the market across sectors, and so you've got a bit of a bifurcation in the market between COVID winners, which have performed fantastically well and been resilient, and then sort of perceived COVID losers, which short term have been impacted. And I'm seeing really good opportunities in businesses in that latter category, where you've got high quality businesses with long-term opportunities and with those kind of sustainable competitive advantages that I mentioned that we try to look for. But you're able to get into some of these businesses at attractive valuations because they've been short-term impacted, because the market is looking relatively short-term and not kind of seeing through to 2022 and beyond. So that's why I'm really excited at the moment. I think that there's a whole host of opportunities, and it's just about trying to be very selective about finding the best ones for the long term.
Lovely. Ken, thank you very much for your thoughts today. Look forward to sort of catching up later in the year and sort of seeing how things are kind of played out. But for now, thank you very much for your time.
Thank you.